Brian, I just want to move on to the international markets because that's our main topic today. We've seen these Asian markets outperforming in the U.S. China is up 10% this year. It's the hottest market in the world right now. What do you believe, or why? I know you said you do. Why do you believe international stocks might have a shot at outperforming the U.S. this year, and any specific areas that you think might outperform?
Yeah, that's right, Bob. And kind of picking up where you started, one of the major reasons we think is because with the new Biden administration, there should be less trade uncertainty. And so I do think that will have a stabilizing effect. In addition to that, the valuations are extremely attractive. On the international side, we saw some of the biggest drawdowns last year. And so we are expecting that snapback. And then, yes, to your point, China is contributing heavily. They've obviously been one of the first to hit that reopen trade, which is driving it. From our perspective, we do like active. One of our concerns is that the major benchmarks on the international side are heavy banks and heavy energy, whereas we're more positive on areas like clean energy, semiconductors, and luxury goods. So we do think there will be some differentiation with that. One of the best ways we think you can play that is with our international growth ETF, ticker JIG. This has 50 to 70 names. It's an actively managed portfolio. Portfolio manager's been in the industry for decades. Does have 14% weight to China, and so we think that's a great way to participate in what we think could be leadership on the international side.
Yeah, and that JIG, there it is, has been straight up for about a year. I wonder if we could put up some of the main components in that. And I see it's Taiwan Semiconductor, Tencent, Alibaba, all names we know. Nestle is one of the few European stocks that are in there. ASML also in that as well. How do you weight this particular international growth ETF? Is it just what goes? How do you decide what the weightings are?
Well, it's an actively managed portfolio, and so we're going to take the names where we have the conviction that we think can participate in the particular sectors that we think are positioned to benefit from potentially this reopened trade, which is why we like that. So, this is a bottoms-up, fundamentally selected portfolio of names where we are doing the research, leveraging our global footprint of analysts, and identifying the names that we think need that weighting, and then we have conviction. Like I said, it's going to be a relatively concentrated portfolio with 50 to 70 names.
Yeah. Jeremy, same question for you. I put up a few moments ago, we put up some of the global markets, and the U.S., as well as it's been doing, is the laggard so far this year. China, South Korea, Japan, even Europe are outperforming the S&P right now. I know you're fairly bullish on international. You've got a suite of international ETFs as well. Why do you think this is a year for international? It's got to be more than just a weak dollar, obviously. What's behind the good feelings on international this year?
Yeah, I think some of the case for international is you have this reversion and trade rotation where you had large cap growth, U.S. tech dominating. You're starting to see that leadership change, and so you're seeing a little bit more cyclicals. Growth globally increasing is good for international. And when you think about the U.S., it's really tech dominated, and it's sort of that shutdown economy doing well for U.S. tech. And as you reopen, the international cyclicals, I think, can do well. Emerging markets on that better trade tension is a long-term view. We think that's some of the growth dynamics, echoing what Brian just talked about. We think those EM tech giants can be, the rivals to U.S. tech giants over the long run. So that's sort of a more of a strategic long-run type allocation. Whereas when you think about Europe, you think about Japan, they can be more the global growth reacceleration, and I think that's where you might see some interest there.
Yeah, you have one of the interesting things about Wisdom Tree is you very much emphasize the importance of removing currency as an effect on it to get to a sort of pure play on the stock prices. You have several hedged ETFs that have done very well. Your Europe hedged ETF, and I wonder if you can explain how this works, how you hedge out the currency, but Unilever, Lind, which is a material stock, ASML, BASF, famous company, of course, another material company, L'Oreal, all major components in that. How do you pull out the currency here? Explain how you're doing that, the currency hedge part of this.
Sure. No, I think that's one of the key questions. When you go overseas, you have to
sell your dollars to buy, euros to then go buy the underlying stocks. And the question is, are you bullish the euro or not? For emerging markets, there could be a high cost to hedge. In the developed world, because of the negative interest rates at the ECB, the negative interest rates at Swiss, negative interest rates in Japan, you're actually paid to hedge. It's not just like a short-term phenomenon. You've actually been paid to hedge on average the last 3 decades. And so we kind of say there's no expected return from currency. It's sort of expected risk. Now, if you think there's a big weak dollar move, that's a reason not to have it, and that's sort of an active decision. But if you don't really know and you're sort of more neutral, hedging lets you get to a baseline of neutral. I think, for EM, again, cost is higher, but for the developed world, Europe and Japan, it's sort of a better than free option that you're sort of paid the interest rate carry to not have to take it. And so I think for Europe and Japan in particular, it's markets we'd say people should be more hedged than they often are.
Yeah, I think that's a really good point. Tom, why don't you weigh in here on your thoughts on the international market? What's striking to me is this is the first time we've actually had this conversation in years. The United States has outperformed emerging markets for I don't know how long, 10 years. It's outperformed China, outperformed Europe for 10 years. I know the era of emerging markets, it seems to me, was the 2000s. That did really well up until the great financial crisis. And then it fell apart. It never really recovered. And only now we're talking about it. Or am I exaggerating a little bit? And tell me if I am. But why is everybody so bullish?
We survey thousands of advisors every week, and they are very bullish on international markets, very bullish on emerging markets. And as these guys said, just to put in perspective, S&P is trading at a forward PE of 25. The MSCI ACWI is at 20, and emerging markets is at 15. So you can actually buy emerging market stocks for a 40% discount. And on top of that, as Jeremy was touching on, there's a strong case for the U.S. dollar continuing to slide, and that can actually work in your favor as well. So there's a lot of reasons to consider that right now. These folks do a great job in global investing. And then one thing to put on top of that, we don't spend a lot of time talking about dividend opportunities overseas too. And both J.P. Morgan and WisdomTree, number one, have expressed concerns about fixed income investing in the U.S. and also have talked about the opportunities for dividend or getting that income in the form of dividend by buying international markets, which are very, very attractive today. So for all the right reasons, it really makes a lot of sense.
Yeah, Brian, last word on the international part of this thing. Tell me, do you think a lot of this really boils down to about overseas is the dominance of U.S. technology stocks in the 2010s? When I look around the world, what is challenging them? I don't see much. I only see some China tech stocks. I see Alibaba, I see JD.com, I see Tencent. Is there any argument that could be made that China tech giants could challenge U.S. tech giants and be a major force in the 2020s, or is the politics of it get too involved? Weigh in on that.
Yeah, so you raise a good point, right? And I think what we're going to continue to see is a difficulty for U.S. tech giants to penetrate China in a meaningful way. Challenges from just a governmental standpoint, languages, how things transfer over. We know that that's been a story for a long time. But we also know that the mainland China marketplace is enormous. The demographics are huge. There was $1.7 trillion in e-commerce sales last year alone. 60% of that is happening on a mobile device. That makes up 29% of their retail sector. So some of these China names have an amazing growth story within mainland China itself. And if those names can just own their own home market, I think you're going to see a huge appreciation from them. There's still a lot of untapped potential in China alone. And then I think we will see them start to come to other markets. But I think they're going to keep themselves really busy in mainland China. To your point, your U.S. tech companies have done a great job really in every other market except for China, where you're starting to see some leadership there. So I think this is going to be a story where you see both Chinese tech and U.S. tech powering forward in their own specific lanes, if you will.
But Tom, where does the politics come in here? Where does the political difficulties China has relating to the rest of the world come in here? I'm wondering if that could prove some kind of break on, all of a sudden, Alibaba is as important as Apple and Microsoft story, the penetration story in other countries. Or am I trying to make too much out of the whole political situation?
No, it's going to be in the spotlight, Bob. And, it seemed that the Trump administration was pretty tough on China and that the Biden administration probably is not going to be as tough. So that will, in fact, bode well for China. However, state-owned companies, the influence on companies like we've seen with Jack Ma somewhat being silenced recently is a concern, and I think a lot of people will be paying attention to that. However, we're still in the early stages of China A shares especially, and there's some great opportunities there as well. So it's an area to really pay attention to. There's some great upside opportunities.